Today, let's go over top 5 Canadian REITs that you should consider adding to your portfolio. If you buy these in your TFSA account, you do not have to pay any tax on the money that you make from these REITs. Hello and welcome back to my channel where we talk about investing, personal finance, and dividends. If you're new here, consider subscribing to my channel and smashing that like button if you enjoyed this type of video. Let's get started. REITs stand for Real Estate Investment Trust. They own a bunch of properties that they rent out and collect money. It's a great way to gain exposure to the real estate market with little money. Usually you would need a down payment to buy a house. And in Canada, if you're buying a house for a rental property, you need to put at least 20% down payment. So if you're buying a house that's $400,000, you would need $80,000 upfront as down payment before all the other fees. With REITs, you don't need a large amount of money to get into the real estate space. You can literally buy a REIT for under $20 and enjoy all the benefits of investing in real estate. There's a lot of work involved when you're the landlord. If tenants call you because of some problem, you have to take time off your work and try and figure out what the problem is and try to fix it. And if you fix it yourself, that will take more of your time, or you have to call someone else to come fix it, which will take your money. Sure, you're allowed to get some tax credit on the expenses that you make on your rental property, but it's still a hassle and it takes up your time. You also have to make sure that your tenants pay rent on time, and if they ever leave, you have to go through the whole process of finding suitable tenants again. With REITs, you don't have to do any of this and enjoy the perks of being a landlord and getting paid monthly. In the US, REITs are required by law to pay 90% of their taxable income to investors through distributions. In Canada, they're not required by law to pay a high percentage of their taxable income to investors, but it's in their best interest because it lowers their corporate tax. They usually pay 75% to 95% of their taxable income to investors. The companies don't have to pay a huge tax bill, and we, the investors, will get taxed on the distributions received from these REITs. It's not the same as dividends, which are taxed at a lower rate. Distributions are taxed normally as if you got a raise on your salary, and capital gains is also taxed depending on how the REITs made their money. It becomes a little more complicated if you hold them in your non-registered account, but if you hold them in your registered account, you won't be taxed at all, and it makes it a lot more simpler. Especially if you hold them in your TFSA account, you won't be taxed at all on the passive income that you receive from these REITs, and your investment will grow tax-free. Summary of all the advantages of REITs. First, you do not have to deal with landlord issues or calls from tenants. Second, it's way cheaper to start investing in real estate with REITs compared to buying a rental property with 20% down payment. Third, you can sell it at any given time, and you get to pick what percentage of your investment you want to sell. You can basically sell 10% of your holdings and get money back for that 10%. You can't sell 10% of your house. It'll probably be like, I'll sell you one side of my brick wall. Even if you wanted to sell the whole house, you have to wait on someone to give you an offer, and hopefully they have the bank approval to get the money and give it to you. Fourth, REITs have high liquidity. You can sell them instantly on the market. And last but not the least, you get instant diversification as soon as you buy into a REIT, as they own hundreds and thousands of properties in different sectors like apartments, retails, healthcare, malls, commercial warehouse, and so on and so forth. There are some disadvantages to it as well. If you need the money in a short period of time, it's not recommended that you invest in REITs. It's like a real estate property. You buy it, wait 5 to 10 years, and then sell it for a higher price. Most REITs don't have capital gains over the years, as they pay most of the income to investors like you and me through distributions, which leaves them less money to invest in the company themselves. And you have to pay complicated taxes if you hold them in your non-registered account. Let's start with my favorite REIT, REI, RioCan. RioCan has a bunch of property that they rent out and collect money. They help build Tanger Outlet across Canada. They own multiple shopping complexes, and they're expanding. They own 38 million square feet of property across Canada, and their biggest tenant is Loblaws. It has a dividend yield of 8.11%, and they've paid distribution for 23 years straight without reducing their distribution payout. It has a payout ratio of 94%. Recently though, the CEO of RioCan at Sunshine released that they were going to cut their dividends by 33%. Which means that their 23-year streak of paying distributions without a reduction is going away. They're securing themselves for 2021, and they're investing in newer projects. This reduction will make the new dividend yield 5.41%. I always thought the previous dividend was too high for the company to keep paying distributions. Now that it's 5.41%, it seems more desirable to buy into the company knowing that they can handle it, and they have exciting projects coming up. Next up is GRT, Granite REIT. It holds a bunch of warehouses, manufacturing centers, corporate offices, and engineering facilities, and rents them out and collect money. They own about 46 million square feet of property across Canada, US, and Europe, and their largest tenant is Magma International, an automobile company, and Amazon being the second largest tenant for Granite REIT. It has a dividend yield of 3.85%, and they've paid the distributions for 8 years straight. It has a payout ratio of 51%. With all that happened in 2020, online shopping has skyrocketed. I think Granite renting out its warehouses will have constant source of income from the company, which makes it a great investment. Next up is CT, which is Canadian Tire REIT. They own a bunch of retail properties that they rent out to Canadian retailers. They own 28 million square feet of property across Canada, mostly in Ontario and Quebec. And have you guessed their biggest tenants yet? Yep, it's Canadian Tire. It has a dividend yield of 5.32%, and they've paid their distributions for 7 years straight. It has a payout ratio of 81%. Canadian Tire is a retail giant in Canada, and they have a dividend growth rate policy that matches the inflation rate. This makes them a great investment for a consistent monthly income-based REIT. Next one on the list is CAR. You should buy a car. No, it stands for Canadian Apartment Properties REIT. They own over 65,000 residential rental apartments, townhouses, and manufactured home communities, mostly across Canada, but they do have some properties in Ireland and Netherlands. It has a dividend yield of 2.75%. They have paid their distributions for 9 years, and their payout ratio is 25%. They're expanding as much as possible. With the other 75% of their income, they're acquiring more properties. This is the largest Canadian REIT in terms of market cap. It's currently sitting at $8.57 billion. Final one on the list is CHP, which stands for Choice Property REITs. They own 66 million square feet of property across Canada, and their biggest tenant is Loblaws. It has a dividend yield of 5.49%. They've paid their distributions for 7 years straight, and their payout ratio is 38%. They're expanding as well, acquiring more retail properties. It's mainly focused on retail properties renting out to consumer staples like Loblaws and industrial properties, which are pretty stable. In their financial report for the third quarter of 2020, they collected 98% of their rent. I think this is a good investment as well. That is my top 5 Canadian REITs that you should consider adding to your portfolio. I want to diversify my REIT investing by buying different types of REITs mentioned in this list. As always, make money work for you, not the other way around. You could check out Simple Trade and start investing today. I have a video that walks you through the setup. I'll leave a referral link in the description box below. If you use that link to sign up, fund your account $100 and buy some stocks with that, you'll receive $10 and I'll receive $10 as well. Let's take personal finance into our own hands and make our money work for us. If you enjoyed this video, be sure to smash that like button and hit that subscribe button for more content like this. Bye!